Hey traders, I'm Delgado, Head of Market Insights at Global Prime Forex. In today's video, we're going to be shifting gears a little bit and talking about volume profile. Now, this is a video that I have been meaning to produce for quite some time. Back in the, I think it was November, December, I produced an article that actually had a very successful hit rate, and it managed to get to the very top of Google rankings. Here you can see, if you search for volume profile Forex, this is a very hot topic. It's got more than 8 million searches, and my article here, how to interpret volume profile structures in the Forex market, came to the very top. Now, ever since I found that I needed to accompany this concept with a video, so here it comes. This is what I'm going to be delivering to you today. Okay, now remember that if you want to visit this article, you can come at our website globalprime.com.au, or you can visit our Medium, and if you really find that this is of value and you want to join our Discord room, I'm going to be providing the link down below at the description box, so you can feel free to join our Discord room and interact with like-minded individuals, including myself. You can ask me any question you want related to trading, and I'll be more than happy to be at your disposal. Now, without further ado, let's look at today's practical example, which is going to be, as I said, going to be focusing entirely on volume profile. Now, first of all, what really is volume profile and what is so important to monitor? And as a trader, you probably heard other concepts such as horizontal lines of support resistance, trend lines, Fibonacci retracements, round numbers. But there's another form of study that can really help you to spot areas where the price is going to be interacting, and it's going to be acting as these areas are going to be acting like launching pads. Okay, it's going to have this spring effect where price is going to be bouncing off. It's going to be acting, it's going to be having this major interest from different players in the market to have the next directional move. Okay, now if you think about volume profile, at the end of the day, it's nothing more than the actual representation through the chart of the market auction. Okay, there are two ways of observing the total volume transactions in every market. One is through tick volumes, because remember that in the sport Forex market we don't have the availability of real volumes as compared to a futures exchange, where you do have that true indicator being available to every single one. Okay, trading futures. Now, if you really want to get the most accurate representation or visual representation of the total traded volume in the X axis, then, as I said, tick volume would be the way to go. And I've also made I provided some case studies as to why it is relevant. Now, alternatively, you can carry out your volume studies through the vertical Y axis, not through the X axis, but through the Y axis, and that's where volume profile has plays a major role, because in this case, whenever you want to analyze the volume transacted at every single price level, then you're going to be having to tap into the study of volume profile, and that's what it's all about. It's a histogram of the amounts bought and sold at specific price levels as opposed to specific times. Okay, and here you have in the chart here this visual representation. You can see here that every single price level is going to be represented with a histogram, and the thicker it gets, that means that the most volume, the most activity that was transacted. The thinner it gets, that means that that price level in particular during that day, during the last 24 hours, was very got very few orders filled at that price point. Okay, so that being said, the volume profile really what allows you to do, or what allows any trader to do, is to evaluate the market context, and it helps you really to keep track of the never-ending auction process that exists in financial markets. That's what a market is at the end of the day. It is a constant negotiating process to find equilibrium or agreement through the accumulation of transactions at certain levels. So the more accumulation of transactions you have at a certain level, the more acceptance, the more widespread is going to be the agreement by the market participants that this is a level that it is equilibrium, because there are many buys and sells that are agreeing at that specific point, at that specific price level. Okay, now if a price is not being accepted and it is rejected fairly quick, and that is, then we're going to have the formation of tails or pin bars, whatever you want to name it. That's going to be, basically just the manifestation of the market telling us, hey, there's this perception that the market at this specific point, it is either too cheap or it is too expensive. Okay, and that's why no volumes are being found, and that's why we don't have the thickness of that histogram. Okay, now remember, the art of reading volume profile is all about studying the anatomy of these market auctions. Okay, now before I take this video further, I want to emphasize that in today's video, even though in my article I was I was emphasizing that there are three different major components as part of the volume profile, that is point of control, high volume nodes, and value areas. What we're going to be most most interested in this video is going to be analyzing the point of control. Okay, the point of control is what you see here in a magenta thick horizontal line. Okay, and basically it refers to the area in the chart with the most traded volume activity. Okay, and this is by far the most relevant area that you want to be monitoring, as it can help you to define the placement of your stops or the areas in the chart where you want to get engaged in buy or sell opportunities. And remember, the highest concentration of volume at a particular price level, the more relevant it is, the more it's going to be watched by the market. Okay, you will be surprised, and what I'm going to be showing you here, without really cherry picking, I'm just going to go through the whole March in the euro dollar market. You're going to be surprised how many times this point of control really acts as a wall on a retest, or it can actually help you massively in the reduction of your stop loss size by just placing stops on the other side of the point of control, etc. Okay, traders, and not only at a retail level, but at institutions and major hedge funds, they are really tapping into the power of this point of control, and it has a tendency to act as I said, as a very powerful area of support and resistance. Okay, now we need to make the distinction, because through TradingView, which at the end of the day is just like the trading platform of reference for the majority of traders out there, it has become worldwide accepted as one that is just being used all over the place. We can have actually three different types of volume profiles to use in our chart. So the first one would be a fixed range, the second one would be a visible range, which can actually take up the whole chart, and the third one, and that's where I'm going to be focusing, and my preferred way of analyzing volume profile is session volume. Now session volume, it's all about analyzing the context of the market on a daily basis. And I personally find the combination of the daily price action activity and its respective flows on a daily basis to be the most accurate representation of what are the intentions of the market. Okay, so session volume, it's really all about being in synchronization with the day-to-day context, as I said. Okay, while while other forms of volume profile analysis or options are by themselves very powerful, I personally myself have always refuse to accept that no other can beat really the ability to reading the daily auctions, and that's why this 24-hour basis reevaluation of what the market intentions are, it's just so powerful. Okay, because it tells you a lot. It tells you what side is in control of the markets, are buyers and sellers accepting higher and lower levels, what side might potentially be trapped and therefore has the higher chances of bailing out on a retest of the POC or point of control. Remember, when the maximum accumulation of volume is going to be present through this magenta horizontal line. Okay, so there's a lot to there's a lot to digest every single day at the end of the 24-hour market auction activity. Okay, now next, and now we're going to be paying a lot more attention to the charts, and we're gonna be making some distinctions about the different types of volume profiles that exist. So the first type of volume profile structure that one should be aware of is what I call single distribution, and that is when we have an inconclusive bias in the market. Okay, and I have been making a separation or division of the different structures that have been present in the euro-dollar market ever since the start of March, and the single distribution is the one that can be seen right here. And I'm going to be unclicking this background, and we're going to make it thicker. So right here in the last 24 hours, and remember this is a 30-minute chart, in the last 24 hours, what we saw was that the negotiating process ended up with no side really in control of the price action, and this was actually represented in this chart by this kind of like belly type curve formation. So you see that here on the edges there's like this kind of tapering process, and towards the middle we have this belly type curve formation, and at the extremes, as I said, you can clearly see the tapering, which means that an exhaustion of prices amid the lack of sufficient liquidity to find equilibrium, right? So these dynamics of price discovery then suggest that the price must revert back to the mean to find new two-way businesses and acceptance levels. So when the price during the day comes up here or comes down here, and you see this tapering, that is, by market auction dynamics, that means that the price is going to have to revert back to the mean, whatever that mean was in the lower time frames, and that is going to end up through more and more multiple successive auctions towards the middle. Okay, and that's very much connected with certain very widely spread accepted laws, such as the law of how it's called. This one is the law is actually the law of normal distribution. Sorry for that. And in the article I actually highlight that, so you can see right here as I keep scrolling down. Right here. So this is the normal distribution law, and what it basically states is that as the volume keeps increasing by n, and n being the number of times a new order comes into the market, then the more pronounced is going to be the shape. It becomes more skewed towards the middle, and that's why we end up having this kind of like single distribution formation in the price. Okay, now the single distribution formation is a structure that leads to what's often referred to as a market being in a range. So in a range, meaning that you can actually clearly predetermine an area of support and an area of resistance. And if you think beyond the kind of like the more conventional technical education, then the formation of a range is just basically nothing more than the test and the failure to agree on higher or lower prices. Okay, so we're kind of like stepping out a little bit from the normal notion of what the heck is a range. So at the end of the day, a range is that the market comes high, comes low, and it just doesn't accept those prices, so it has to come back to the middle based on this normal distribution loss that I've just gone through very briefly. Now, whenever we have a single distribution, the market will try to constantly be exploring new prices up and down. So notice how the price went down not only one time but two times. Here we went down only once, and then came back into the mean, back into this this middle belly kind of shape. Now, what's really important is not so much whether or not a level has been tested, but the ability by the market forces to accept. So the moment that we're starting to see, let's say the next day, that the market is breaking these levels and is starting to accept through the formation of more thickness on the histogram, that means that more volume is being transacted, so there is less chances that this is going to be there's more chances that this prior range is going to be officially broken, and then the market is just going to be making new auctions into higher prices, lower prices, depending on the direction of that single distribution break. Okay, now the question when we have a single distribution is how can we get prepared to trade these structures the following day, right? So whenever we're presented with a single distribution, also known, as I said, as a range, the areas of interest will include and it's very important here because this is one of the most common mistakes by traders, is that they're gonna basically end up over trading, and whenever you have over trading is because you are getting involved in less than optimal levels. So whenever you have a range, that means there's a whole lot of a creation of noise, and there's going to be only very few levels that are going to be pristine and clear enough for you to engage. So whenever you have, as I said, the single distribution, the areas of interest will include the extremes of the range, or alternatively the side in control of the POC. So by the end of this day, on the March the 6th, and this was just hours ahead of the ECB meeting, which saw major volatility to the downside in this case, the areas that you should have been only looking to engage would have been the low end of the range or the high end of the range. Those are the two only areas that you want to be engaged on, and especially because we saw that the price was actually closing right around the POC. Now if you have this same single distribution but the price ends up at the very highs of the day, you can potentially, and upon your discretion, upon other forms of analysis like intermarket, something that I touch on a very regular basis, you could then get to test the hypothesis of playing longs or playing shorts, depending on this case if it had closed at the very highs of the day, playing longs off the POC. But as I said, it's going to be very limited areas that you want to be engaging whenever there's a single distribution, because the market is being much more messy, much more whipsawing, and much more erratic in nature. Okay, now we're going to be moving on, and there's what I would call the multiple volume distributions. Okay, and these are whenever we see directional flows in the market, and this is created by an imbalance of demand or an imbalance of supply between these two currencies. Okay, remember, at the end of the day, Forex and how we trade Forex is by an exchange of one rate against another. So the value of the euro is going to be cross-referenced against the US dollar, against other currencies, and this is going to be how they're going to move is based on the basic laws of supply and demand, market auctions, and this is going to be visually represented through the chart itself. So when it comes to multiple volume distributions or directional flows, then we can actually make a distinction of 4 of them. I'm going to be touching on these 4 in a minute, but it really, as I said, multiple volume distributions, which you can see one here, it really refers to an auction process that creates 2 or more areas of value by a noticeable volume accumulation in the histogram. So you can see here there's a notable volume accumulation, there's a second volume accumulation, same here, one volume accumulation area, a second volume accumulation area, in between there's almost no volume being transacted. So in the majority of cases we will have the creation of these 2 distributions, less so the cases of a triple distribution structure, even though it is possible. And in this video what I'm going to be showing you is a few examples, and I'm going to be categorizing what type of shape we are seeing, or what kind of a structure. Okay, now the first one that we can be looking at is what I would call the short L shape. Now the short L shape is when we have a market that becomes directional, but we don't have longs being trapped, and we don't have these longs being trapped just because the POC actually it ends up being very low in the context of a short and bearish market. Now as part of this formation, we need to really clarify or classify what type of structure it is based on, where most of the volume was traded as depicted by the POC. So in this case here, that's where the POC occurred. Okay, so this is going to give us this reassurance, this confirmation and conviction that the price actually closed right around the POC. There was a whole lot of equilibrium being found at these levels. So the next day, and always bear in mind that the context, that you can obviously analyze the previous days, previous few days context, and if it's on a very conducive structure of lower lows, lower highs, and on top of that you have a short L shape, that's going to be massive, and that's going to tell you that the market continues to be communicating that the path of this resistance continues to the downside. Okay, so you know, these market dynamics are most powerful for they're very powerful for a trend continuation, as long as I said the context is in your favor. If you're gonna have a short L shape, but that's gonna be within the context of a fairly clear bull market, just because the structure of the prior 4 or 5 days is not in your favor, then you have to be, you know, taking things on tenterhook and like really be much more cautious and prudent about your approach to the market when it comes to this short L shape. And what we can see here, if we were to just draw a rectangle and extend this rectangle through the next day, and this time we're going to be clicking the background so it's even clearer. So you can see here how this is going to be an area that the next day it's going to be retested several times, and it's going to be acting as a wall. So basically there are many bids that are coming off these lows, but are struggling to actually find enough buying interest so that we can break through this POC. Okay, so that would be then an opportunity where you can start finding sell side opportunities of this POC for the most potential risk reward prospects. Okay, so that would be a scenario where the short L shape formation would be you know, greatly enhanced for your chances to succeed in trades by engaging in, as I said, in short trades of this level. Nothing is guaranteed, and you know, it is far from certain that the next, let's just say, you know, that the next 3 to 5 formations that you're going to come up with in the charts are going to be playing as nicely as this one. But you know, the only thing that as a trader matters to you is what areas do you want to engage, and then obviously respect your you know, your professionalism, how you're going to be going about risk management, psychology, and so forth. At the end of the day, as I always say, the entry is only going to make up for a little bit as a component for your ultimate success as a trader. There's much more to it, that you have to be, you know, you have to be much more well equipped in many other facets other than just finding the area. Now, finding the area is just one more box that you're going to be ticking, and it's a very important one, especially if you're going to find these confluences of, you know, finding the POC, finding the right context. And this is an example where we did check enough boxes to believe or to have the conviction or the idea that this is an area where price could actually be you know, pulling from. Now, a few more extra tips about this short L shape is going to be that any potential rebound will most likely see, in this case, sellers committed and adding to their short positions right at that POC. So if you actually ask yourself, why is it that we continue to see more and more selling pressure, most likely in this present context, that is short sellers, they are going to be adding their positions. You know, this is a pattern that runs the risk of resulting in shallow rebounds before the continuation of the trend, especially if whenever you see the pattern, the price is going to be closing below the POC. And it is very important at the end of the New York business, do you see that the price not only is creating this short L shape, but is it actually the price closing below the POC? If that's the case, you run the risk of having this short or shallow pullbacks, I should say. Okay, now in the case of this short L shape formation, the prospects of shorts being trapped, or at least you know, choppier moves the next day is going to be increasing the moment that you are going to see that the price is actually closing above the POC. So even though you're going to have this short L formation, if you see that price closes above the POC, that means that there has been a significant pullback in the market, so there's not as much conviction to be placed in this trade. Okay, now a rule of thumb would be that if the price, even though we have this short L shape, closes above the 50% retracement of the day's range on a short L shape, you should definitely also be worried that the trend continuation would be, you know, a bit more debatable the next day, with risk of a range or a reversal growing. Okay, so just be aware of it. Okay. Now the next formation that we see, it's called the short P shape. Now this is similar in in the intentions of the market, but the formation itself, it has different, it has a different structure. Now, the majority of the volume here, what occurs is that the value is being built to the upside, while the downside saw comparatively lesser activity as depicted by the volume profile. So you can see here that most of the accumulation occurred to the upside, while on the upside comparatively it didn't find as much acceptance, even though we see a fairly bearish communication by the market, just because we have a price that is closing pretty depressed levels. The POC is being left behind, and whenever that occurs, think about it. Why did this happen, and what is going to be the consequences of us having this price accepting lower levels, even though the POC was at a much higher price. So whenever that happens, you're gonna find that the market has been trapped long. So there was an awful lot of accumulation of buys and sells at this level, and the moment that we break and we close, as a psychological kind of cue, the end of business in New York is going to be very important, because if we close at that time, that means that through Asia, through Europe, and through the US, there has been this consensus that the price now, the fair value is lower as opposed to where most of the volume was transacted. So whenever that occurs, that means that there's going to be an awful lot of traders, in this case buyers, that got upside down. And so whenever that's the case, and this is very interesting, and it kind of like it starts to get you to the next level of knowledge and getting this rhythm of the market. So essentially what happens here is that all the buyers at the top that facilitated the build-up of volume right here, they're now trapped, which means that any rebound towards the POC becomes an interesting proposition to add shorts, especially if it's in line with the underlying trend, right? So remember that. And at the same time, and even more interesting, and allow me to now draw and extend the rectangle of this POC, and more interesting, not only it becomes appealing for new shorts to add into the market, but at the same time, those that played long positions facilitated this business and are still with the position open in the market. What do you think they're going to be doing? What's going to be the most sensible strategy for them, knowing that they got upside down? Well, if they have a buy, well, whenever the price comes back, they get lucky enough and it comes back above through this level, or testing this level I should say, then they're going to be closing their positions, and by closing their positions it means that they're going to be selling the market. So there you have it. There you have this added pressure through the sales of those that got trapped being long this market. So now you have two different sides that are going to be looking to play shorts in the same direction. You have those that have been committed playing this trend in the first place, and then you have those that were looking for a reversal, got trapped, got actually got the wrong side, and now whenever they have an opportunity to bail this position, they most likely will do so. So that's going to be creating this effect. And whenever the price came up here, so it saw a fairly a very quick reaction to the downside once again, and that is just simply the manifestation of a market that is not it's not perceiving that there's going to be a major recovery, and those longs obviously are finding it a good deal just to close the positions at a break-even or with a limited loss. And that's kind of like, that's the effect that it creates when you have longs being trapped in the market. Okay. All right, let's continue moving on. The next day we saw an outlier volatile day. We had a short P shape, but notice that the move here was about more than I would say almost 3 times the average daily range on the euro dollar, which continues to be in very depressed ranges and very limited volatility. So whenever you have this massive day of volatility, I would just basically just simply ignore the structure and let the market go back to its normal volatility levels, and from there you can start analyzing. Now the next day, what we see here is that volumes are spread all over the place, and even though you see this POC, notice how the difference between this histogram of this POC and then this POC and then this POC and then this high volume node and this high volume node is pretty well balanced and pretty well spread out across the whole histogram of the last 24 hours. So personally, what I would do is I wouldn't really place much weight, and even if you were to place weight and you would consider this to be a long P-shape which has bullish connotations, you have to be reminded that this is going to be a structure that occurs on the back, and this is what I was pointing out before. Not only pay attention to the structure, to the formation that you see, but also what is been happening in recent days. So what happened in recent days simply is that this was just a retracement on a very firm, on an underlying bearish trend. So whenever that's the case, then you definitely want to be much more cautious. Okay, so we're gonna now let one more day go by so that we can continuously let the market enter new dynamics and see whether or not we can be provided some new cues, okay, for directional purposes. So the next day, what we see is yet again another, what I would call a long P shape. Notice how most of the volume it's concentrated on the top. At the very bottom of the daily range, there's a lot of tapering, and you can see this tapering effect here. So it kind of like the volume starts to be reduced, and it goes in it continues to go lower and lower, and it continues to go higher as I move the cursor to the upside. So whenever you see a long P shape, what basically means here is that there is not going to be trap shorts, but in this situation there's a risk of follow through continuation with the trend right off the bat, especially if you're going to have the prices closing above or around the POC, okay? And this is very much the opposite of what was I explaining. So this would be the opposite of a short L shape, okay? So whenever we have this pattern, this is going to be something that you want to be well aware of if you're going to be still holding short positions. And the reason being is because after 2 days of a of a retracement, and despite the setback we had on the back of the ECB, the context would still be favorable after 48 hours of a retracement to look for or starting to be more favorable to buy for deep opportunities, as the latest indications actually are that both buyers and sellers are starting to agree on higher prices here. You can see how if this was a healthy sell side trend, you would have seen potentially one retest, two retests, perhaps two retests, and then selling off and then prices accepting lower. But that's not the case. What we saw instead was that the buyers were coming back, and were coming back around this level, about a 1.1225 or thereabouts. Okay, and the end result after 24 hours of trading is that you have this long P shape. Okay, so when these structures occur, the buyers that kept the price bid up this high are not gonna easily give up without a fight. Okay, that's where the opportunities to buy the dips tend to arise. So if you see that there are so many buyers accepting these levels, whatever dips you see the next day are going to be potentially buy side opportunities. Now this this potential buy side bias gets even more reinforced whenever you see that the price is breaking higher, especially on a very impulsive move, and then you're starting to see again, and it's a pattern that continues to play out through this example without me cherry picking. But notice how not only the POC from March the 8th, but also the POC from March 11th, the next Monday, align around the same level. So we can capture the area between 1.1250 and 1.1240, so about 10 pips, 1.1250 obviously being an important round number, and see what happens the moment that we actually broke above this previous double top formation. Then we're starting to see buyers being much more interested to buy off, and not only buying off this two double top formation resistance area that now acts as support, but at the same time the POC was just right underneath. So again, the POC in this case is acting as an added layer of support for buyers to come into the market and starting to look for potential opportunities to engage in the long side action. Now the next 2 days is what I would call a long L-shaped structure, okay? And out of these 2 days, I would say that this second day is the clearest of all, because you have this first histogram and this area of volume accumulation, and then you have this upthrust bar, and then at the end of the day, you see how the price ends up closing way higher than the POC. So what we can do here is just we can draw the POC, and I'm going to be explaining to you what this pattern is about, the long L shape. Now first of all, remember, as in the concept of the short P shape, the long L shape is also going to find players trapped on the wrong side of the market. So if you think about it, what we saw here with the accumulation of volume is that there were an increasing number of sellers and buyers exchanging bids and offers around this level, and the moment that this level broke, then those that were short were starting to feel the pain, were starting to feel the hit, because the market was going against its direction. Now if by the time that these shorts were got trapped, and by the time the price actually traveled north, they still didn't close their positions, because they might be micro traders, or they might be just kind of like taking a more wider stop, and they still have their conviction about shorts or whatever it is, or because many traders at the end of the day, especially institutional level, they're going to be using a fairly wide stop, and yet going to be reevaluating and reassessing the market conditions the next day. So what's going to happen the next day if you have a long L shape is that those that were short are going to be looking to bail out of the market the moment that the POC, the moment that the opportunity for them to get out for limited damage is found. And that's what happened right here the next day. We saw that the market was actually finding retracement, and at the POC, that's the area where we acted, that once again acted as a support for price then to resume its trend, which by the way now has ended up more in a kind of like a range bound kind of context. Okay, so allow me then to untick this one, and that's the current context of the market. But anyway, I still want to go on a little bit and explain a few more concepts about this long L shape. So basically, the long L shape, unlike the previous subcategory, the long P shape, not only we find that the shorts are going to be trapped, but notice that because of this previous 3 days of higher highs and higher lows, the prior structure has been much more constructive. Notice how we've actually broken this level of these previous highs, pre-ECB level highs. So that's going to be reinforcing this this notion of the market looking to bail, and that's going to create that double effect for the buy side pressures to re-emerge once again. Okay, so always remember, pay attention to the context of the market. In this case, this upthrust bar, what it caused was a change in structure, really, because I mean this was a double top formation, and it was on the back of just ahead of the ECB. So now knowing that we've broken this level and we have a long L-shaped formation in terms of volume profile, that's going to be very powerful, and that's going to be almost perfect scenario when it comes to this concept that I am putting out for you to understand better today. Okay, now it is in this, also remember, it's in this type of retracements that again, as I said, we might see the best opportunities to engage in buy-side business as as the pricing of the pair really returns to retest an area where not only real sellers got trapped, but if you think about it, there might be sometimes other confluences. So let me see if there was another confluence here. The trend line got actually broken, so not much confluence here. You can start to look also for confluences in terms of previous support previous resistance turn support, and what I'm starting to perceive here is, notice this swing high, it got broken, and that was a retest, right? So the retest of this previous swing high came also at a time when the POC was being tested. Okay, now as I said, you always want to be paying attention to the close of business in New York. So in this case, it was just really perfect because the price had really closed at a very high level, so that was an equilibrium being found, and whenever that's the case, that is really going to strengthen the notion of this being a market that is going to be having buy side connotations written all over the wall, all else being equal, of course. Okay. Alright, so I've gone for about 40 minutes. I hope that this explanation today has been of use, have been helpful for you. Remember, if you want to subscribe to the YouTube, I'm going to be putting an awful lot more of valuable insights, and always focus for me is just providing the new concept that can be actionable for you traders, and make some comments and have your say. I'm going to be at your disposal, and if you really want to join our Discord room, I'm going to be there available, and I'm going to be by your side trying to perfect, we can continuously and together perfect the craft of many traders who are joining us. And that's pretty much all I wanted to share for you today, with you today, and I'll be back with more videos tomorrow. It's bye for me. Thanks.